All right, so in the last lesson, you and your co-founder got started on some big stuff. You incorporated your company and you built your first cap table. And now you're off to the races, making Meetly into the next big startup. In this lesson, we're gonna dive a little deeper into the fundraising process as you graduate from convertible instruments to priced rounds and valuations. You ready? Let's dive in. Okay, so first, let's do a quick recap. So far, you and your co-founder authorized 10 million total shares. You reserved 1 million of those shares for incentives for employees or advisors who you might want to pay some equity. And you split up the other 9 million between the two co-founders. You took 55% of those 9 million shares, and your co-founder took 45%. Next, you brought on an advisor. You gave them 100,000 options in exchange for their help. And after that, you raised your first round of seed funding from an investor named Carol. Carol gave you $100,000 via a SAFE to help you get through the first several months. Now remember, this SAFE is a convertible instrument, meaning you haven't given Carol any of the shares of the company yet. But you have promised Carol that in the future, you're going to figure out a valuation for your company. When you do that, you'll naturally know your share price and you can convert her $100,000 into shares at that time. Okay, you ready? Let's now fast forward 9 months. So it looks like that advisor you brought in was a huge win. They've helped set up some things on the tech side. They got some project management going. Things are looking pretty good. And now you're ready to take things to the next level and raise your first major round of serious funding. That means it's time for you to enter the big, scary world of venture capital. Welcome to your Series A. You've got a beautiful pitch deck that outlines your vision, the market opportunity, and the early success you've had with Meetly. And even better, you've been on the networking grind and you've got some meetings on the books with a couple of VCs. But that's not all. A few of these VCs actually really like your company. They want to give you some money. Just like that, you start receiving offers. Real quick, let me say that fundraising is never actually that easy. You're going to hear no a lot before you hear your first yes. So just keep that in mind. But meanwhile, that $100,000 that Carol gave you is almost all spent. You got to get some money in the bank. So it's time to make a decision. You decide on an investor you like. Let's call them investor number one. You work out a term sheet with investor number one, outlining the following terms. They're going to give you $3 million on a $13 million post-money valuation. We'll talk about what a post-money valuation is in a second, but just know this deal is going to incorporate a whole bunch of math, including an increase to that option pool you created earlier and the conversion of that SAFE you have with Carol. At the end of it all, when you do all the calculations, you'll end up with a Series A price per share of 0.9337 cents. So just to be clear, right now, what we know is this. Investor number one is giving you $3 million, and they're getting a share price of 0.9337 cents. So in all, you are giving investor number one a total of 3,213,023 shares. So you get with the lawyers, you draft the agreements, you go through the due diligence, and in a few weeks, the deal is done. Congratulations. You just raised $3 million and added over 3 million new shares to your cap table. So let's take a look at where your cap table sits now. Okay, so you can see already the cap table is starting to get a little complex. Let's work our way through it. If you remember, before the Series A, Meetly had authorized 10 million shares in total, right? But now, investor number one just bought roughly 3 million new shares. This means as a company, Meetly now has roughly 13.2 million total shares. Many of those shares are already issued, but remember, there are still 900,000 unissued shares. Those are reserved for possible new advisors, consultants, or early employees. But that's just the beginning. Now let's dive into a topic that trips up a lot of founders that we work with, the valuation. If you take away anything from what I'm about to explain, let it be this. At this stage, do not raise money without a lawyer. While we're not lawyers here at Carta, we have worked with tens of thousands of early stage companies, and we've seen plenty of instances where the founders didn't understand how valuations work and ended up accidentally giving away more of their company than they originally expected. Work with your legal team to make sure you understand the specifics of your fundraise. It's really worth it and really important. Okay, so valuations. In its simplest form, a valuation is exactly what it sounds like. It's the value of your company, aka how much money is my company worth. There are two key types of valuations that you need to understand. They are the pre-money valuation and the post-money valuation. If you think of your fundraise in 3 stages, stage 1 is your company before the investor's money comes in, stage 2 is the fundraise itself, and stage 3 is your company after the investor money comes in. A pre-money valuation is the value of your company at stage 1, and the post-money valuation is the value of the company at stage 3. So when you raise your Series A, your investor might say something like, we want to invest $3 million at a $10 million valuation. But it's important for you to know, are they talking about the pre-money valuation or the post-money valuation? And here's why that's super important. Looking at this in a totally isolated scenario, if it's the post-money valuation, then your company is gonna be worth $10 million after the money comes in, which means today, your company is worth $7 million. Another way to look at this, your company is worth $10 million when the raise is over and investor number 1 is buying 30% ownership of your company. Or on the other hand, if the $10 million is your pre-money valuation, then the investor is valuing your company at $10 million today, before they give you any of their money. So after they give you $3 million, your company will then be worth $13 million. Again, here's another way of looking at this. Your company is worth $13 million after the raise is over. And the investor in that case is buying 23% of your company. Again, this is a totally isolated example, and our scenario is already looking a little more complicated. So you need to ask, hey, investor, with this offer you're making, are you taking 30% of my company or are you taking 23%? Now, this language will typically be in the term sheet, but it's important for you to understand beforehand as well. And if you don't have this info cleared up, you might find out that your ownership stake has been reduced by more than you expected. And if Meatly goes on to be super successful, that one little misunderstanding could end up costing you tons of money. But you're smart, right? You're working with a lawyer and you're asking all the right questions, and it turns out, yep, this was a post-money valuation. So let's recap. You received $3 million. Everyone did a bunch of fancy math, and when it's all said and done, you are now the co-founder of a $13 million company. So now you can just sit back and relax. Just kidding. It's about to get a lot crazier.